This is Trepp Wire Week in Review for week ending March 11th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the $1.9 trillion relief package was signed by President Biden after a vote along party lines. And the U.S. plans to buy 100 million more doses of the single-shot J&J vaccines. To date, 33 million Americans have been fully vaccinated, and economic data released was encouraging. Projections for U.S. GDP growth are expected to be 6.5%. Initial jobless claims beat expectations, and U.S. consumer prices rose less than expected last month. And the ECB plans to ramp up bond buying. While we're still dissecting the details of the stimulus, we got to think about what some of the impacts are to the CRE market at this stage.
Well, first of all, let me say it's great to be back. I had been on the sidelines for a couple of weeks, and I'm back in the saddle, and I'm happy to be here. Thank you to Lonnie for pinch hitting for me and for.
Thank God, because our listeners were starting to mutiny.
It was just a CRE aside. I was in South Florida for a couple of weeks, and I was staying at a hotel that backs a CMBS loan that went delinquent for the first time in February. And I was there for 2 weeks, seemingly playing full boat. And so if this loan goes current this month, you'll know that, you have me to thank for this particular cure. But back to the economic data at hand, all eyes right now for the last 2 weeks have been on inflation. The 10-year Treasury got as high as 1.64%. which is about 110 basis points higher than the trough of last year. It's also about double. It was double the rate that we had around Election Day. So it's a meaningful uptick, and that's what really caused a lot of jitters over the last 2 weeks. We saw a 10% drop in the NASDAQ during that time frame. We saw a lot of volatility. We saw people coming out and saying, we could start seeing 3 and 4% inflation and real problems coming with that. This week, some of the pressure has ramped down because of 3 things. And Martha, you really touched on several of them. The first was that the consumer price data came in less hot than people were thinking. So the original thesis that the economy was running super hot right now, that was tapered down just a bit by the CPI number this week. That helped put a ceiling on Treasury yields this week. That was followed right after that by a very successful 10-year auction. People were wondering how much demand there would be for the 10-year, which was auctioned off on Wednesday. That demand was solid. That too helped put a cap on the 10-year Treasury rate. And then this morning on Thursday, the ECB announced that it would be accelerating bond purchases. So it was going to effectively work to keep rates from spiraling out of control to the upside. So that last point had a lot to do with European stocks rallying on Thursday, and U.S. stocks subsequently rallying as well. So let's put this in context for the CRE market. What are the 2 biggest threats right now for the market? I will put them in order of what I perceive to be where guys could get their heads handed to them. One of those risks was taken away when the ECB came in and said it's full steam ahead with bond purchases. I assume that the Fed will continue what they're doing for a long period of time. We're not going to see a tapering anytime soon, but if we were to see a tapering, it would not be out of the question to see bond spreads and, as a result, cap rates go up 100 or 200 basis points in short order. Right. And that makes all of the cuspy properties out there that have been benefiting from coupons, refinancing coupons in the 3s, more likely to either look for extensions or defaults. A distant second is a 10-year going to, let's say, 2.5. And why do I call that a distant second? The reason is in the second half of 2021, when you look at the loans that are maturing, most of the loans that are maturing have rates, as Joe pulled for me this week, in the 5 to 6% range. So even with a 2.5% Treasury, most of these loans should be able to get refinanced. It won't be with a 3% handle anymore. It'll be a 4, 4.5, 5 handle, but it's not catastrophic. But if you're looking for something which is potentially catastrophic in terms of valuations, mark-to-market valuations, it would be either or both of the Fed and the ECB coming out in the next 6 months and saying, we are going to start tapering. And that's the time to put on your track shoes and start heading for the exits.
My bigger question among all this is, how long can they keep doing this, right? How long can they keep buying bonds, keep printing money, keep artificially tamping down interest rates? Because I don't believe that they're ever going to go back to normal and letting the market decide these things. So it's more like, forget about what happens if interest rates rise. Like, what happens if they never rise? Do you know what I mean? Like, I also liked, Tyler Durden on Zero Hedge is a perma bear and is always pointing things out. But one of the things I saw this week was that the CPI data is really kind of somewhat farcical. They weren't able to collect certain data points on certain items that are in the CPI basket because people couldn't go to stores to go see how much stuff costs. So they had to impute a lot of it. And then, there are things like, how can you say there's no inflation when home prices are up 15%? Like, it depends on what you mean by inflation. I guess wage inflation is the thing that everybody cares about and worries about, because that goes kind of to corporate earnings and all that type of stuff. But I've come of age in an era. I came out of college during the Great Recession. And ever since I've been working my entire life, the Fed has been printing money and doing quantitative easing. And I think there's this whole generation of us who can't even contemplate the idea of the Fed not being there to backstop the market.
Right. When is it one too many? And the interesting thing this week is, as soon as the House passed this stimulus bill, the White House and its supporters were out there talking about what was coming next, right? They're talking about a $2 trillion infrastructure deal. They're talking about another COVID-19. And it reminds me, when I was in college, we used to go to this place called A&W. It was kind of like a fast food place. You don't see very many of them. And they used to have 35-cent chili dogs on Tuesday night. So we would go down there and have the 35-cent chili dogs. And we'd usually get 5 of them. And we'd always ask, what happens if you have 6? And nobody ever had 6. We always thought if you have 6, that's the end, right? You're going right from A&W to the emergency room. And there is a number with our stimulus or stimuli, at which point it's the 6th A&W chili dog on a Tuesday night, where everything gets ugly very fast, but you just don't know if it's number 6, number 7, number 8, number 9, right? But they have these things on the, ready to take off, these other stimulus out there. And it's not out of the question that we could see another 3 or 4 billion proposed before the end of 2021.
Yeah, I guess it's just a question of like, is it okay for the US to continuously increase its deficit like astronomically? And is there a point in the future? There has to be. I mean, we've only been around for a couple hundred years, right? There has to be a point in the future when some other country can come along and say, you know what? Why are you using these guys as your reserve currency when all they do is print money all day? It just takes a few, very, very, very large kind of sovereign investors to say, we're not going to be buying treasuries anymore because this is just getting out of hand. And that's when the whole world ends. I mean, I just don't know if anybody would ever let that happen because, the ripple effects would hit them right back in the head.
Well, one of the remarks this week was, I forget who said this. I'd give it credit if I knew who said it, but their retort to all this stimulus is, why are we even collecting taxes anymore? If all we're doing is printing our way out of this thing, why even bother to collect the money in the first place? We don't need to. We could just go on unlimited, money
Right.
printing as long as we have ink, right?
Well,
we're good.
That goes back to your snide remark from several weeks ago, which is like, only suckers pay rent, only suckers pay their bills. Like,
It was ironic, not snide. Ironic.
That's the right word.
Let me clarify that. I said, what happens to the world if everybody starts to believe that only suckers pay rent?
Right.
I wasn't advocating that or talking about myself as a grifter.
Well, I heard this on another podcast, I'll give them credit. It's called Animal Spirits. They were talking about this stuff more like a financial podcast. And I've been looking at some of the data recently, and part of the reason they're saying that we haven't seen as much inflation as you would have expected, given the massive amounts of stimulus that's already come out, is the fact that lots and lots of people have just put this right into their savings account, right? So it was something like the bottom quintile or the bottom 2 quintiles spent most of the stimulus that they got, or if not all. But then there was this whole other swath of the universe, which got a lot of the money, which again goes to your point, Manus, of being nuanced. Like, I shouldn't be getting a stimulus check. I mean, I'll be happy if one shows up at my door, but I really shouldn't be getting one. I think there's a ton of people who have padded their savings accounts, and now they're buying NBA Top Shots or Bitcoin, or they're trading on Robinhood or whatever it is. So I think that's why you don't see the kind of rapid inflation that you would have expected. We may see it in 21 now that people are actually going to go out and start spending it.
But to your point, we already have seen housing inflation. It's undeniable that we've seen energy inflation, right? I would say gasoline prices seem to be up 50 cents a gallon over the last couple of months. And we've seen many, many firms come out and say that they're going to start paying $15 or $16 minimum wages. And the firms that are announcing this are the ones that can afford to, right? The Walmarts and the Targets and so forth. But that will drag wages higher for people in other industries, right? Restaurants and other places. And that can't help but have some kind of inflationary impact at some point.
So looking at the stimulus, if we look at some of the details, how effective is it at helping the industries that are the hardest hit?
My only takeaway so far that I can really think of, I mean, there's all the obvious stuff, right? There's rental assistance, and there's the checks straight to people that can help them pay their rent, which helps landlords pay their debt, and so on, which keeps kind of multifamily humming. My only thought is that there is so much money going to the states. The budget holes that have accrued because of COVID, especially in the super lockdown states, are almost all shored up by this stimulus bill. I don't know all the details, but I think I saw something that, the deficits are going to be significantly lower due to this stimulus. So maybe, now I don't believe this for 1 second, but a rational human might say that means these places don't have to raise taxes, right? We were worried that places like New York and Illinois and, California and those types of places are just going to increase property taxes and increase other taxes to make up for these deficits. Now they don't necessarily have to if the federal government is making them whole. I think it's insane for me to say this because of course they're going to raise taxes, but
they do it for sport. Yes. I mean, I think the problem with this, the stimulus from my point of view, and I'm not trying to make an editorial comment, but, very little of it went to really stimulate, right? They said only 10 or 11% of it really went to, cover those that were impacted, right, in the form of checks to people. It was a very blunt instrument, to your point, Joe, that we weren't giving it to just those who needed it. We were giving it to a lot of people. It's a number that could stimulate inflation down the road, and to the point of giving big chunks of money to the states. I certainly understand that they have been hammered in their tax revenue by this downturn. There's no denying that. But I am a little bit worried about the notion of giving a city or a state $10 or $15 billion, expecting them to spend it wisely. Right. Part of me thinks that this goes in one funnel, out the other funnel, and the funnel that it goes out on is not necessarily the most productive. And that's kind of, a big concern for me.
So exactly 1 year ago today, the World Health Organization declared that we were in a pandemic. And well, we could not have predicted the ways our lives were going to change and the economy was going to change. What were some of the biggest surprises?
So the biggest surprise for me was, I think it was right around this time. I think it was like the first week I was working from home. It's when my wife said, I think I should take a pregnancy test. I said, what are you, crazy? Why? And we got a COVID baby. So I think that's the biggest surprise for me personally. I'll give you some other surprises after Manus does his.
So we'll go through the property types in a minute, but
good segue there.
That's right.
It's a hard left.
On an overall basis, kind of more broadly than just CRE, surprise number one for me is I can't believe how long this has gone on. I was incredibly bullish on the shortness side of this. For those that listen to some of the earliest podcasts in March, I was saying this would be over by Mother's Day. And it had nothing to do with the seriousness of the situation. It had more to do with, number one, as a society, we have really short attention spans. And I thought, within 4 weeks, people are going to say, well, we've done the COVID thing. Let's move on to something else. And number two, I think we can't, as a society, sit still. And I think people would have come out and said, risks be damned. I'm going to the movies. I'm going to the Ranger game. I'm going to the bar with my buddies. And that never really happened for the most part. So that was a real surprise for me. Surprise number two was just how young people reacted. I think, they're on the lowest end of the risk category, yet they seem to be the most nervous about things like, going outside, meeting up, going to holidays. And where I was not surprised, I think this was like podcast 3 or 4, I channeled Cedric Maxwell, the old great Boston Celtic, who said, get on my back and help the Celtics win a title back in the 80s. And I said, there's a guy in Cambridge,
two beakers, mixing beakers together
with 2 beakers. And I said, we're a nation of, innovators and workers and problem solvers and creators. And, whether we're fighting fascism or fighting poverty or fighting racism or whatever it may be, people really work hard to make this country a better place. And, I said, somebody in one of these places is going to work until 4 o'clock in the morning and figure this out. And as it turns out, that happened in 5 or 6 places, right? Moderna and Pfizer and Johnson & Johnson, AstraZeneca, and they pulled it off. So that part to me was not surprising because I know when push comes to shove, that's who we are and that's what we do.
So I would say surprisingness level would be, first of all, the absolutely rapid snapback in the stock market. We were down 30 or 35% in March, and I think we had gotten back all of our losses in a month or 2 after that. So that was big. I mean, there's part of it is driven by the fact that the vast majority of the value in the stock market now is in Amazon and Google and Facebook and Zoom and Tesla and all these technology type companies, which a lot of them actually benefited from COVID, like very much so. I would also say, it's in a similar line of thinking as Manus, but just the idea of if this had happened in 2005, we would not have been able to do all this lockdown stuff. All this lockdown stuff would not have happened because technology, like think about it, 56K modems. Like you can't do Zoom calls. You can't like operate a business on 56K modems.
How about a
right?
dial-up?
Remember that sound? Right? Man, this is trying to do the
Manus
sound.
is trying to make this sound right now. And
so like
classic.
In a lot of ways, the things that make our lives easier, more efficient, whatever you may say, and probably more stressful, more anxiety ridden, the whole thing allowed like the government essentially to have some pretty draconian measures on businesses and institutions and things like that. And I think that the biggest surprise really is that everybody just accepted it, like there were some little protests here and there on like state capitals and stuff like reopen, but like there was everybody just says enough of this already, and I don't know why that is. I think a lot of it has to do with technology. A lot of people can stay home and work and continue to get paid. And a lot of people can watch Netflix and Hulu and Disney and all this other stuff that if they didn't have that in the past, if this was 2005, everyone would be sick of their 57th time of watching Indiana Jones and the Last Crusade on DVD or VHS, and they would be going out.
Shawshank Redemption.
Shawshank Redemption.
Or in Joe's case, reproduce, right?
Exactly. Well,
That's why I said F.
just to round out the surprises, I think some of the numbers were staggering. The number of deaths over 500,000, jobs lost 22 million, 5 trillion in stimulus money. I mean, these are numbers that are hard to contemplate. And yet some I felt like weren't as bad as they could have been. Like the number of bankruptcies in the retail market, the number of businesses that were closed. I feel like there could have been so many more in those numbers that we didn't see.
I couldn't agree more. I think that, we were expecting mass defaults in the energy segment that would have impacted the CLO market. We did expect a lot more retail defaults and bankruptcies and so forth. I'm not sure if this is true or not, but we may have seen fewer bankruptcies in 2020 than we saw in 2019 and 2018, right, in the retail segment. So I fully agree with that assessment, Martha. Turning our attention to the property type stuff, I'll give a couple of surprises here. On the retail side, kind of continuing that thought, I was surprised at how few resolutions we've seen. We were looking at some CMBX 6 data recently, and I was surprised at how few resolutions we've seen, only really 1 or 2 loans being resolved away yet, and a small fraction of the properties being reappraised. So for the CMBX shorts who are hoping for really speedy resolutions, they have to be disappointed. They were hoping that these things would happen fast. And for the longs who have been collecting their insurance premiums, it's been kind of blunting some of the pain that they felt on a mark-to-market basis. But that really surprised me that we haven't seen more trouble there. On the office side, the surprise is how quickly firms have said that they're going to make work from home permanent. That they've really just said, we're going to go to permanent work from home, or 2 on, 3 off, or, we're going to shed 40% of our office space. I would have thought there would be more of a wait and see, but many firms have already really shown their hand already, and we know what they're going to do. And then lastly, on the hotel side, it's a little bit like the retail, relatively small number of resolutions. These guys are clawing with their fingernails, trying to hold on to that cliff. Good for them. They're fighting for their properties. Other than New York and Houston and Chicago, guys have been really digging in. I know we've talked about, maybe 40 or 50 properties, the borrowers are ready to throw back the keys, but, that's not all that many in the grand scheme of things when you've seen occupancy fall to 20%. So, that's great. And bully on the special servicers and the whole CMBS industry for tapping this FF&E innovation. But I would have thought, given the pain in the hotels, we would see 10 or 20 or 30 sales per month or per week at this point.
I still think a lot of those are coming, Manus. I think that even though we will see a snapback in demand, I think there's still going to be a lot of pain that needs to be resolved. I think a lot of that is still coming in the bank space, right? And then I just think that another cliche, I think we flatten the curve on losses, right? And reappraisals and all that other stuff. And we're going to have fewer than we would have otherwise, but I still think that a lot of that is coming down the pike.
Well, I think it'll be multi-market. We've talked about this before. I think on the vacation destination side of things, I think that these people hung on with good reason, and they'll work their way out of this. Maybe in convention sites, maybe less so. But I have to think that if you fought this hard for your property and you've endured this for a year, you're not going to let these things go very often without a fight. And you're going to keep digging in. You believe in the property. You believe in the prospects of a comeback. And so I'm bullish. I think that you're right. We'll see heavy losses, but I'm hoping that they surprise to the downside.
So let's move on to some of the current news. We'll start with retail. We had a number of stories on closures and modifications.
So a lot going on. They're very disparate. I'll run through them one by one. They're not really connected very much, but here goes. Disney announced that they're going to close 60 of their stores to focus more on the digital side of their business. If in none of the cases are the store's top 5 tenants behind CMBS loans, but they are tenants, inline tenants at many malls that back CMBS loans. So this falls in the category of one of those death by 1,000 cuts. It's another tenant that has probably somewhere between 8 and 10,000 square feet. When you add it to the roster of other tenants that have gone away, Payless Shoes, Route 21, in the old days, Radio Shack, Wet Seal, people like this. This is just another nick to the mall owners. And Disney stores, I think, at least for me, they're kind of lures, right? It's a place where you can go and you can send your kids in there while you're doing other things. And so I think this is a loss for the mall owners. On Friday morning, we're going to put out a page on our website which lists the malls and the CMBS loans for which Disney will be shuttered. Again, it's not a death blow, but it's another straw in the camel's back. Other stories, we saw Kroger out in California. They became the latest grocer to announce they would be closing some marginally performing stores. This is in response to the HEROES Act, which mandates that grocery store workers and pharmacy workers get an extra $4 or $5 per hour in pay. We've seen it in Long Beach, California, in Seattle, and now in Los Angeles. Grocers saying, we're out, we're not paying this, our stores are not profitable, and rather than operate in the red, we're going to close these stores. So that was another story we were following this week. And then lastly, and I'm happy to share this story, this will be a freebie if people come to us and ask, the Outlets of Mississippi became a modified loan this week. The modification was shepherded through the process by our friends at the Henley Group. They are CMBS workout experts. They represented the borrower here. They worked with a special servicer to come up with new terms. And at the end of the day, what this modification looks like is it extends the maturity date. The borrower put in some fresh capital to show that they still had skin in the game, and the loan was split into an A note and a B note. So now the A note, for which the borrower, the first cash flow will go to on these loans, is slightly higher than the value of the underlying property. So it kind of evens out the value of the property versus that A note. There is a new waterfall that pays some cash to the owner before the B note is paid. And then should the value of this asset recover, there could be payment back to the B note holder that would limit the loss to CMBS holders. This is the first CMBS 2.0 modification like this of its type. We saw this in spades in the great financial crisis and the aftermath. But if you're interested in this, we're happy to share the details on this story. And the people at the Henley Group, David and Tammy that worked on this, they were guests on a former podcast of ours. So congratulations to them on pulling that over the finish line.
So you say, Manus, that's the first one, first AB split of its time. Should we call it a hope note, or should we rebrand it?
You could call it a hope note. I think that that's fair. The guys at Ironhound may take exception with the first of this. They had a deal that had some similar traits to it. I forget the name of that deal. In their case, there will be loan forgiveness in the future. So it's not really a bifurcation per se, but we've talked about that in the past. But this is the first. We'll give Henley Group the credit. And if I'm ever on CMBS Week on Jeopardy, I'll have to recall this under loan modifications for 1600.
And we saw that New Jersey's American Dream was back in the news.
Yeah, so there was an interesting quote from an executive from the 555 Worldwide, which is the company that owns the American Dream Mall. They happen to also own the Mall of America. The executive from 555 was being interviewed out in Minnesota, where they produce most of the property tax cash flow for the county. And he said, they were talking about the American Dream, and he said it would have been much better if American Dream would have burned down or a hurricane had hit it financially, because we would have been covered by insurance. This pandemic that we didn't see coming has not been covered and was the worst scenario imaginable. So this loan is not in CMBS. However, there is basically a workout going on where the lenders on this particular loan in the American Dream, which is that one you drive by right before you see Giant Stadium or after, depending on which way you're going, they are actually having to put up some stakes in their other malls as additional pledged equity towards this workout. We're looking forward to seeing remittance reports for the Mall of America, which is in CMBS, over the next month or two to see if there's any mention of this.
So yes, that construction loan or completion loan, whatever you call it, on the Dream Mall, the collateral for that was 49% in those two trophy malls, Mall of America and West Edmonton Mall. And Bloomberg was reporting this week that 555 could lose that equity stake. That 49% will be called as collateral against the Dream Mall. So does this impact the Mall of America? Not per se, not unless somebody comes out and says, the value of this thing is now $600 million versus a $1.3 billion mortgage on it. It just means that there'll be new ownership involved. That new ownership may take different, and it's a minority stake, a different look at, how to keep this going, whether they want to extend the mortgage even further and so forth. It's an entanglement, if you will. But as Joe said, we will be looking for the remittance data next week on that Mall of America to see if there's any clues as to what's happening there.
Turning to office, we saw this week that office occupancy rose just 0.7%, signifying a very slow return to business as usual.
Yeah, I think office right now is probably the biggest source of debate for our industry. There are people that are very, very bearish. There are people that are somewhat bullish. They think that in a couple of years, this will be all behind us and things will be back to normal. And, this is like two sports fans arguing about who's the best center fielder, right? Nobody gives an inch and they all think that they're going to be right, and they are right. It really remains to be seen. I would say I'm modestly bearish at this point. I do think that the sublet space is a real issue. I don't think we've yet to see a firm take more space now than they had on a retired lease or an expiring lease. We've seen many examples of firms giving back space, either via sublet or saying we're going to renew, but at half the footprint that we had before. And I do think that this weighs on the market for a long period of time. I think that there's a long overhang. That being said, the market does give us, and researchers do give us, conflicting points of view. And I'll talk about the San Francisco market just a little bit. This week in San Francisco, we saw that Salesforce announced that they were walking away from a project that was going to be built to be their primary headquarters in the Golden Gate area. They also announced that they'd be subletting hundreds of thousands of square feet on Mission Street in that city, right? So that's about 1 million square feet between the two projects that they're walking away from. So that's the negative side of the story. Yet this very same week, we saw two properties in the Bay Area sell. Uptown Station was sold by Kilroy, $419 million. It's an Oakland office, over $1,000 a square foot, setting a record for the Oakland area, that submarket. The property is fully leased to Square. And then we also saw the Exchange on 16th Street sell for $1,440 per square foot in San Francisco. So both of these guys can't be right? You can't say to me that on the one hand, people are giving space up hand over fist, and on the other hand, we're seeing record valuations at a time where we could be facing rising interest rates. So somebody's going to be right and somebody's going to be wrong.
So we also, I think we put out a report or a blog this week specifically about San Francisco as of January, based on our research as of January 2021, total amount of office sublease space available was 8.4 million square feet, which is 2.5 times where it was before COVID. In New York City, at the end of 2020, it was almost 19 million square feet. That's essentially double what it was in July, and significantly higher than it was pre-pandemic. So it's almost like fire sale situation here in some of these. Like if you're Salesforce or Square or one of these other ones that have recently announced, it's funny you mentioned Square because I think they had another office building where they were looking to sublet a ton of their space, which we talked about several weeks ago. I can't remember which one it was, but if you're looking around at the market and you're thinking like, I got to sublet this space, like this is not the best time probably to be putting space on the market, but at the same time, it's like, I got to get rid of this before another month passes and sublet rates go down even faster. So it's like, who can offload their space fast enough? And then who the heck is going to actually lease these spaces, right? If it's Salesforce, like that's the type of tenant that in the last several years has been a huge occupier of space, right? These large tech companies. So if the tech companies are offloading space, who's there to absorb it? I don't know.
I'll take a little meandering right now, just because we were talking about the Bay Area.
I missed it. I missed the meandering.
Here we go.
The meandering. San Jose is not the Bay Area per se, but it's close enough. Did you see the story that the Las Vegas Knights were in town to play the San Jose Sharks for 2 games, and they were in their hotel and they were asked to leave because the hotel owners had gone bankrupt, and I guess they just had to clear everybody out. And so you could kind of say, boom, boom. The Las Vegas Knights were checked out of their,
nice.
hotel.
That's very like a triple entendre right there with hockey.
Nice pun.
That's right.
All right.
But it's interesting, that hotel does back a $100 million floating rate loan that has remained current throughout the pandemic. And I think they would have really liked that extra night of the Las Vegas Knights there, because their occupancy in 2020 was 18%. Ouch.
It's like a much more elaborate version of pulling the fire alarm on the visiting team's hotel the night before the big game.
That's right.
Let's get to the deal of the week.
The deal of the week this week was brought to us by the Baltimore Business Journal. And by brought to us, I don't mean they're advertising to us. It means I just found the story on their website. This was the sale of the St. Paul Plaza office and garage. The combination sold for $44 million. Why is this noteworthy? It's noteworthy because Maryland and Baltimore is not exactly a growth area, and it's downtown, attracting high-end tenants. The property itself had gone through a nasty tenant dispute in recent years. The asset was valued at $47 million in 2014. So for this to sell for $44 million in kind of a limping along market in a questionable office economy, and after a tenant dispute, I think that's a good sign. The asset has already made its way into a 2021 CMBS securitization, which is great. And the tenant base itself, by the way, we're not talking Facebook and Amazon. We're talking about Maryland government agencies. So it's nice to see something in uncertain times get done like this. And as is my MO, I try to kind of underscore things that provide hope to those parts of the market that have struggled. And hopefully that did that.
I have to give a plug here for CRE Direct, because you mentioned, the story and where you got it from. And, just in case anybody doesn't know already, if they haven't been listening, CREnews.com is Commercial Real Estate Direct. It's a publication which puts out 20 or 30 kind of transactional news stories every day. Often they are in our kind of roundup of places we look for stories on a daily basis. So definitely go and check them out. And by the way, if you want to listen to our podcast while you're reading, even though I know that's hard to do, there's a little link at the top right. You can just click on it and listen while you're there.
So let's go to shoutouts. We had a number of them this week. Steel City, AKA Yinzer Dave. was actually messaging us while we're recording right now saying he's a big fan. So there it is. Bald-faced effort to get a shout out. Dan McNamara, who we've talked about a number of times, he's actually been on the pod. He actually noticed that I wasn't on the pod a couple of weeks ago and welcomed me back. So I have to thank him for noticing.
Us non-Manus people,
I know.
it's
We don't
nice
get
when
enough
we get
love.
when we get a little love.
Yeah.
It's like 98% Manus, and then 1% being Martha.
Exactly.
Don't sleep on Haley. Haley jumped in and pinch hit 2 weeks
No,
ago.
she got big kudos when she stepped in. So she's already made a mark. Michael S. from Wharton, and apparently he got a tip to listen to our pod from Double Line and is a big fan. So thank you, Michael. William W. emailed us about delinquency rates for CRE CLOs and was interested in getting a little bit of dialogue going with Joe on that. So he did that. Tim T, he says, we're the best. Loved the webinar access that you were on, Manus, a few weeks ago, the JMBM webinar. Sarah on Twitter, she said she hasn't been into podcasts that much, but the Tripwire podcast is an excellent choice for CRE info. So thank you for that. BB Dogged Tenacity gave us a Twitter shout out. He liked the Green Street 15% reduction in office based on a 4-day work week. If you remember, we talked about that with Lonnie. Robert G reached out to compliment us, and he was actually looking for some recommendations for some educational materials on CMBS. And I know Manus sent him a few things regarding that. Donut Shorts on Twitter gave us a hat tip. Thank you for that. He was commenting on a WeWork story.
We're also going to have something from Donut Shorts and Trepwire. I
believe so. Look for that on Friday morning.
Does that mean the Donut Shorts on Twitter is unmasked?
No, it just means, we're just going to have to trust that what he tells us is true. I believe him, but if we're wrong, we have nobody to go after other than an anonymous Twitter guy or gal.
Anonymous tip. And to round out, we had Chris W., who complimented and asked for a t-shirt, and Fourth and Jort. He actually was the one who tweeted the missing Manus image on the milk carton. So Manus, you were definitely missed.
So let me see if I could pull this shout out off. So it could be the mother of all digressions. And they say absence is the mother of digression, right? And I've been absent for a couple of weeks. So as many of you know, I've been on the sideline for a few weeks. Many of you reached out via email, LinkedIn, and one clever guy, as Martha just said, put my face on the side of a milk carton, which was really, really hilarious. I was grateful for that. My kids thought that was really funny. In any event, I was out taking care of my dad, who passed away late last week. And that event, other than for his friends and family, is not really an extraordinary event. I wouldn't even mention it other than the fact that he's been a recurring character on the podcast for some of my slice of life stories. And we had many great laughs together. But his passing inspired today's meandering shout out. So here goes. And Haley's probably already getting ready to put this in the same category as the lost Bob Dylan tapes. But my dad was like a lot of other people of his generation. He got up every morning for 40 years, waged war with the Long Island Expressway, which is the only way to describe it. He only waged war with that road. He was an educator. It was never lost on him that his neighbors paid his salary. So he really strived to bring his A game. He saved for his kids' education. He paid his bills, treated everybody with dignity and respect, donated to local causes, and that's who he was. And like I said, there's nothing extraordinary in this. We all lose our mothers and fathers over time, and that's the way it is. And in short, he lived his life like 98% of our listening audience does, often overlooked and taken for granted. But my point is here, where would we be without the tens of millions of people like him and like you, our listeners, that live that way? You really provide the starch that keeps our society from unraveling. We're in times right now where everybody's tearing each other apart on TV or Facebook or Twitter. And it's really useful to be reminded that people like that, like you, like Joe, Martha, Haley, are the vast majority. It's the people that are tearing each other apart that are the minority. So this shout out is really for all the people out there that listen and have humbly productive lives like my dad did. And people used to say this bud's for you, right? My dad wasn't a beer drinker. So in his honor, I will say to everybody who's lived their life like he did and continues to do so and tries to really keep us together and humane, this extra dry Tanqueray martini on the rocks with a tryst, that was his Friday night go-to drink, is for you guys. Amen.
So with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or just a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.